We live in a world where money is at the core of our society. No country can thrive without a form of money, and our living standards highly depend on it. So having a good understanding of the basics of economics can be quite useful for understanding how money works. In the book Naked Economics, author Charles Wheelan takes away the complexity from some of the most fundamental theories from economics so you and I can easily understand them. And if you're ready, let's get started. Idea number 1. Who feeds Paris? This is a rhetorical question economists often ask as a way to show how crazy the series of events that happen every day are in order to make our modern economy work. For example, somehow the right amount of fish from the South Pacific Ocean makes its way to a luxury restaurant in Paris. A neighborhood fruit vendor has exactly what their customers want every morning, from fresh coffee to delicious mangoes, even though those products might have come from 10 different countries. As a consumer, we go to the store and buy an item, but many of us don't realize that this highly efficient system is made out of billions of individual transactions. From the fishermen selling the fish to distributors, distributors transporting and selling the fish to the wholesalers, and wholesalers selling the fish to a restaurant, and the restaurant cooking and selling the fish to you. And this happens in every business, in every industry, in every country in the world, which makes up the world economy. Number 2. It'll sort itself out. There is an old Cold War story about a Soviet official who visits an American pharmacy. He sees every aisle lit up with every type of remedy and medicine, from bad breath to ear infections. Very impressive, he says. But how do I know all stores have these items too? You see, in the Soviet Union, the government directed everything from the bars of soap that a factory can produce to the number of students graduating electrical engineering. This resulted in an inefficient economy, and not all stores could provide what the customers needed. The US and many other countries have adopted a free market approach, where there's no centralized authority deciding what can be sold and for how much. Stores sell the products that people want to buy, and in turn, suppliers make the products that stores want to keep in stock. This system allows demand to be the deciding factor in allocating the resources where they will be the most productive, and it creates high levels of efficiency. Let's say that local restaurants begin getting a higher demand for red wine. This causes the restaurant to order more wine more often from distributors. Distributors might need to adjust their delivery schedule to deliver more efficiently to keep up with demand. Manufacturers begin producing more wine and buying more grapes from farmers. As a result of the increase in demand, farmers are able to upgrade their machinery to become more efficient at harvesting grapes. This allows the machine producers to improve their technology and make better and more efficient machines. As a result of a free market, resources were allocated where they were the most productive and created a highly efficient system. Number 3. The wealth gene. There is a reason why there are people who can travel in private jets and visit space just for fun. This is the result of a combination of our natural self-interest and a free market. One of the most basic economics principles starts with a simple premise. People will act to make themselves as well off as possible. In other words, they will seek to maximize their own utility. This innate instinct of self-interest is what makes a free market highly efficient. If there is demand for something, there is an opportunity to make money. Wheelan argues that this is a great thing. By allowing people to fill the demand of the market, the government doesn't have to. The market improves and corrects itself. It generates wealth for the country and employment for the people, and it improves the standard of living of its citizens by creating the products and services they need. Now, there are negative consequences of people's natural need for self-interest. The principal-agent problem occurs when there's misalignment between the principal, a company, firm, or the government, and an agent, which is an individual. A huge example of this misalignment was the 2008 financial meltdown, where, due to aggressive incentive programs, led many investment bankers to buy up substandard credit investments that filled their pockets with money but let the investment firm deal with the consequences, and ultimately, the US government was left holding the bag. The communal resource problem happens when an individual incentive creates problems in markets around communal resources. Communal resources are limited resources that everyone has access to but no one owns, like fish in the sea. This problem arises because individual incentives are rarely aligned with the incentives of a larger group. This often creates the incentive for people to cheat the system. It would be beneficial for every fisherman to limit their daily catch. This way, they allow fish to continue to reproduce and continue to fish forever. But it benefits each individual to fish as much as they can before someone else does, which depletes the supply and destroys the environment for everyone. Although it might not be perfect, Wheelan argues that capitalism and the free market system, although flawed, is still the best option, since there is no other system that creates the efficiency and innovation that a free market system can. But there's an important factor that keeps the free market from destroying itself. Number 4. Government or anarchy. Humans have the tendency to put their needs above others. If left unchecked, markets tend to destroy themselves. Like in the case of Nigeria's economy, where it became difficult and expensive to conduct even the simplest business. Nigeria has one of the world's largest reserves of oil and natural gas. Yet, it has not created major economic prosperity due to an ineffective government. Governments are able to provide the infrastructure that allows the free market to thrive and create a more effective society. They do this by protecting property rights, providing public infrastructure, and helping those in need. Imagine that you are quite creative and you invent a new technology, but someone else comes and takes your invention and sells it for their own profit. Without the laws protecting your property, there would be very little incentive for you to innovate and invent new things if someone can just come and take it for themselves. In order for the economy to produce value, ideas and properties must be protected to create the incentives for a free market to function. Let's say that there's no government to create the roads, but this grocery store needs a road so their delivery trucks can bring the product and to make it easier for their customers to reach them. So they pay to build the road. This sounds like a great idea for the business, at least until other grocery stores begin using this road too. What's the problem, you might ask? This creates a disadvantage for the store who actually paid for the road, since everyone can run their business without having the expense to build the road. And due to this competitive disadvantage, businesses would not bother creating roads, causing everyone to be worse off, both businesses and citizens. So a government road paid for by taxes is the only fair solution to this problem. Angola is a country rich in oil and diamonds, but the wealth created has financed over a decade of civil war and not economic prosperity. In a free market environment, it is inevitable that some people will create great wealth while others might struggle. The government's job is to create safety nets to allow those who are struggling a chance to build a better life. This can help the prosperity of the free market by not letting society fall into a civil dispute, although distribution of wealth is more of a philosophical topic rather than an economics topic. For example, will a tax increase meant to benefit the poorest people be more effective than increasing the economic growth of the country, which can potentially lift the poverty line, essentially making the poorest people better off? This becomes a matter of opinion and not economics, but let me know in the comments your thoughts. Number 5. Human capital. Imagine you are trying to predict a good economy. On one side, you have 10 highly educated individuals. You have structural engineers, chemical engineers, doctors, scientists, software developers, and agriculture engineers. On the other side, you have 10 undereducated individuals, and you give both the same level of resources. Which of these groups do you think would create a more effective economy? Human capital is the sum of characteristics that make you valuable and marketable as an individual. This can be your education, your intelligence, your work experience, and your physical abilities. Economists estimate that 75% of our modern economy is driven by human capital instead of physical resources like oil and steel. There is a striking correlation between human capital and economic wealth in any given country, but it's not necessarily the same for countries with natural resources. England and Japan, for example, have a high level of human capital and are some of the richest countries in the world, while Nigeria has a tremendous oil deposit but has a comparative lower standard of living and a significantly lower level of human capital, such as education and job training. Human capital is what drives a country's economic wealth, but also your personal economic growth. Number 6. How to get rich with financial markets. Many centuries ago, economies consisted of trading goods and services. Then money made it easier to buy and sell these goods and services, and as a way to store value. Now we have financial markets, which are designed to move and manage money. Today's financial markets can be very complex. If stocks and bonds are not complicated enough, we have options, we have futures, we have options on futures, interest rate swaps, credit default swaps, and the list goes on and on. But all financial instruments, no matter how complex, are based on 4 simple economic principles. To allow people to raise money, to allow people to store, protect, and profit from excess money, to insure people against risk, and to allow people to speculate. Financial markets, such as the stock market, tend to have a reputation for allowing people to get rich quick, but Wheelan says that this reputation is misleading. Although people can get rich quick in the stock market, the undeniable truth is that most get-rich-quick strategies fail because of 2 main reasons. Number 1. All available information is public. It is unlikely that you will know more about a stock than other investors. To make money in the stock market, you are looking to find an undervalued stock that no one has noticed yet. But in a world filled with people who are constantly looking at the market, it is unlikely that you will find something that has been overlooked by a million other investors. And you are not only competing with other investors, you are competing with supercomputers programmed to look at price imbalances. And if, for some reason, you have information about a stock that the public doesn't and you use it, you will go to jail. This is called insider trading, and it's illegal. 2. People typically do not undervalue their stock. When you buy a stock, you believe that the stock you're buying is valuable, but so does everyone else who holds the stock. Therefore, the price of the stock will already reflect how others view the value of the company, which means the price of the stock might already be on par or higher than the intrinsic value of the company, and getting a good deal becomes difficult. Instead of trying to get rich quick, which is quite difficult in the stock market, and it comes with a high risk of losing your money, Wheelan gives us a few guidelines to keep in mind to successfully invest in the stock market. Number 1. High rewards come with high risk. Companies that have more instability try to convince people to invest by promising higher returns. But there's a higher chance of losing the investment. Established companies and governments offer lower returns, but they tend to be much safer. 2. Diversify. The market has continuously swings and cycles. So to protect yourself from these market swings, diversifying in a variety of assets in different industries can limit the downside of the fluctuation of any one asset. Index funds tend to be a great option for diversification. 3. Invest for the long run. Investing at its core is providing money for someone to do something productive with it. As a result, you should be compensated for it. The longer you hold an asset, the more likely that this investment will grow, even after those occasional dips in value. Make sure to check out this video on the little book of common sense investing, which shows you a simple path that guarantees getting a fair share of profits from the stock market.